the issues that arise from using a loan is first, you're paying interest. So you're not earning interest, you're paying it to someone else. You have a time loss because you have to go out there and qualify for the loan. I've seen people that take up to 6 months to go get some loan that they qualify for from the SBA, the Small Business Administration. They're getting all the documents. I think they have to give them blood by the end of it. I mean, it's crazy because you have to give your taxes and your credit score. And certain types of loans can actually negatively or adversely impact your credit score. And therefore, when you go get a car loan or a credit card or a line of credit, you might end up paying higher interest rates there as well. See, when you go borrow, it might even put your assets at risk because they might use those assets as collateral. There are 4 assets that will make you rich. If you don't know about them, or if you don't invest in some of them or all of them, just plan on a slow, tedious disappointment with most retirement planning. It's going to be filled with failure and risk, but it doesn't have to be. If you master these 4 assets, then you'll have a game-changing impact on your wealth and finances. I've invested in a lot over the last 25 years. For me, it began at age 15 when it was a car wash. Then at 18 years old, mutual funds. Then I looked at some storage units and car washes that were automated that I could buy, and instead decided on oil and gas and a hard money lending fund, which is bridge financing. So before someone got their bank financing, I would finance it until they got the long-term financing. Then I even did some developing in real estate and even invested in commercial and residential properties. Look, none of this is what makes the difference. What makes the difference are these 4 assets. So what are the assets that make you rich? Is it tax liens? Is it the storage units? Is it car washes? Is it options tradings? Is it startup companies? Is it private placement memorandums, if you've heard of these? These are where you can have 100 or less investors. Certain of them have to be accredited at a certain level. Is it hard money lending, where you're doing that short-term financing? Is it private equity and getting involved with something maybe as a pre-IPO or even an IPO? Is it gold and silver or cryptocurrencies? There's so many investments out there, but let me break this down into 4 assets that make you rich. The first thing is businesses. Businesses are absolutely a huge piece of this. And I'm not talking about businesses that are public businesses. I'm talking about private businesses. I endorse the book Buy Then Build by Walker Dyville. In it, he highlights something called acquisition entrepreneurship. Acquisition entrepreneurs, as he says, start by buying an existing business instead of starting one from scratch. So many of the ones that are started from scratch that are kind of the Silicon Valley, tech ones, a lot of those make no money. They raise money, they burn through it, and they fail. Well, if we look at acquisition entrepreneurship, it stacks the odds in your favor. See, if you begin by buying a business and then take an entrepreneurial approach to building more value, this allows you to improve cash flow or get cash flow from day one. The combination of an existing small business's profitability and sustainable infrastructure with new innovation and drive by an entrepreneur is a magical recipe. So if you're an entrepreneur, this could be a great thing, because if you go out there in the stock market, how much are you paying for that? If we look at the profit of a major corporation that's in a mutual fund, for every dollar you have, it might cost 10 times more for that company than a private company. Meaning, you can get a private company for 2 or 3 times multiple, or you might be seeing a 30 times in the public market. So there's this awesome opportunity here. See, the main benefit of acquisition entrepreneurship is that existing companies are already established with customers, brand awareness, employees, and most importantly, revenue and profits. All the things that a startup doesn't actually have. So instead of having to go out there and raise money for months and maybe often years, while also trying to build sales from scratch with a new product, the acquisition entrepreneur acquires a profitable infrastructure from which to begin. Existing businesses provide established markets, so they first don't have to worry whether they're too early or whether another company with more funding will beat them to market share. And in some cases, they don't have to worry about creating a market from scratch, right? Simply by buying a company, typically one greater than 1 million in revenue, you can remove so much of the risk that's inherent to entrepreneurship. Tim Carden, who's been on many of the YouTube videos with me, his brother Ben Carden, they've both done this. They've both gone out there and bought existing businesses and seen extraordinary success. This is also much better than putting your money in the stock market, like I mentioned, without knowing what's happening in a boardroom there and who the employees are. And with so many of the S&P 500 giants, they just move really slowly. That really limits growth. But most importantly, most of those stocks provide no cash flow or very limited cash flow. It's all appreciation potential. See, that multiple, as I mentioned, on a small business can be so much less, a fraction of what a large publicly traded company is. So there's so much opportunity inside of small companies that operate on legacy-based systems that have never upgraded to lean business models, meaning they've got old systems with tons of waste, and with the new insight, maybe there's ways to plug the leaks, to eliminate that inefficiency, and you don't have to go develop something from scratch. And maybe it's even like my friend Mike Geary that just is really good with online marketing, and he could get a business and immediately make it profitable from day one with his existing businesses because it's complementary. So I can hear you. You might be saying, I can never do this because I'm not rich. First, let me say that in my experience, very few entrepreneurs raising capital to launch any startup is actually rich. So I'm not sure the comparison of all that's too valid. That said, although brokers typically want to see a few $100,000 in available cash, it's the nature of buying an existing business that makes it much easier to gain access to capital. See, banks offer loans to buyers for up to 90% of the purchase price using the assets of the business as collateral. So according to Walker, the financing in these deals is typically done in one fell swoop, with you bringing a down payment or some type of equity infusion and the bank providing the balance. In addition, raising money from a bank means that you get to own 100% of the company yourself. You're not giving up equity. You don't have to have partners. And see, owning a business that generates recurring revenue is key. Recurring revenue can create economic independence. Recurring revenue can provide cash flow now versus waiting for 30 years for a retirement plan. So some questions that Walker would have you ask is, can this operate without my daily involvement? Do you know the metrics that matter and how to manage them? Can you create consistent cash flow with that business? Is the business something you can sell? Or is it just another job? I mean, it might be a self-employment opportunity, and maybe that's okay for you. But if you already have a business, can you acquire a business that you know how to monetize better than its current owners? Is there something complementary out there already? So, look, starting a business, that's a lot of effort. And it might take a long time before you get to cash flow. But what if you can already take a cash flowing asset and merely improve upon it and find ways that there's less reliance on you because there was already infrastructure? This is less risky if it's something that relies on your skill versus a startup that requires funding to release a technology that requires a lot of infrastructure. So that's the first asset. Existing small private businesses that you can get for a lot better price than major corporations. Price for the profit. All right, the second one is real estate. Real estate is an asset that can be good for some and bad for others, just like buying a business. See, it all depends on you. Risk is in the investor, not the investment. So all these assets are a lot more active versus fully passive. A lot of people just want to hand their money over and hope that it works out. That passive type of investing has seen such a massive failure rate because people don't know whether it's working or not. People are just trusting and hoping, but they're not sure if it's really the right thing to do. You can make these investments more passive over time. But without your input or responsibility, it's rare to find something that works from day one with no involvement. Real estate is to be treated like a business. To increase your odds of winning and avoiding mistakes, I'm going to take you through some of the keys from the book, The 5-Day Weekend, that I co-authored. Obviously, this video isn't an exclusive treatise on real estate investing, but Nick Halleck has done a ton of it. I've done a ton of it. And so here's what we came up with in the book. My goal here is to give you enough of the foundation so you can move forward with confidence if real estate's your choice. You'll need to learn what works for you. But here's what you'll want to know. Number one, focus on cash flow. If you have cash flow from day one, you're going to lower your risk and you can have that profitability. Second, the profit is in the purchase. When real estate is done right, you make money not when you sell, but actually when you buy. Three, look for multi-unit properties. So it's one financing deal, but you're getting multiple properties. And then if there's one vacancy, you have other properties that are producing cash flow. Number four, get your financing in place before you buy. So meet with the bankers and the planners and understand the loans and maybe even get pre-approval. Number five, know your market and your numbers. So before you buy a rental property, know the market you're buying in. Collect solid data. This might mean that you pass a lot of things up, but know what your parameters are and be educated before you invest. Number six, don't get impatient and or emotional. You got to manage your excitement. That might be bringing other people to the team and having other people that might be, okay, I don't think this is the right time to move forward, even though you might have rose-colored glasses. So I want you to be carefully analyzing things and be logical. Number seven, buy in the right location. Location is an absolute key to profit. Study market trends, learn where the deals and demands are. Number eight, Find properties where you can build sweat equity, right? So these are things like the older properties instead of new properties, where you can increase their value through upgrades that you put into them. Number 9, be smart about your renovations. What's worth the money and what's not worth the money. See, I want you to keep your budget expenses to 15% of purchase price. 15% of what you purchase it for could be the expenses that you can add. So find a pattern that works for you. Add value to rent out the properties faster, manage these properties wisely, screen the tenants, create systems for receiving the rent, have an emergency fund because things do break down, and make sure you have enough cash on hand to handle repairs. So I've given you a bit of a list here, but the key is I want you to hold on to your cash, because if you tie too much up in property, equity isn't always accessible. So be careful and don't over leverage. Put maybe, make sure you're buying at 15% below the normal market value. Put 20% down to build in a buffer should the market crash, and understand market volatility and exit strategies. Things change quickly, so be on top of the trends and be prepared for the worst. As you hear this, you might say, "Phew, that is a lot." Well, maybe real estate's not for you. But there's other people that geek out about it. They just love it and they're willing to do this all day long. Be careful what you invest in. The first thing is buying businesses. The second is real estate. And the third is intellectual property. This is that third asset. So much of what people spend their time enjoying is intellectual property. I mean, think about TV shows and movies, watching comedians, to the content here on YouTube. So where do you personally have expertise? Can you improve the industry that you're in? Can you educate people on a product or process that solves a problem or improves someone's life? So I can also get recurring revenue through books that I write or subscriptions to memberships. Like if you went and looked at wealthfactory.com/Garrett Club, this is one of those memberships. There's an investment every single month, but people get me every month where I'm doing a Zoom call, I'm answering questions, I'm tackling a topic, I'm giving some of the newest things that I'm creating, I'm giving them a lot more depth than I might be able to in a 10 or 20 minute YouTube video. We give them these golden tickets where they can redeem certain, things like a financial trend summit that we did, telling people how to navigate a tough economy, which we're facing right now. We've got things like if someone's launching a business, a program that we call Scale, or if someone wants to become economically independent, a program called Curriculum for Wealth. And so they can redeem these with these golden tickets, and there's a concierge that kind of helps them out. I just did 19 calls the other day with people in that program to really discover and figure out what challenges that they're facing so that we can add even more value. And then we actually print a report every quarter of things that they can implement. So if you want to see intellectual property, you can go to wealthfactory.com/Garrett Club and take a look at it. I actually created a playbook for those in that club to take an idea to market without requiring borrowing of funds or risking all their money. It's my win then play playbook. I actually got a big compliment from my wife the other day. She says, "This is really good." I'm like, yeah, maybe I know what I'm doing, right? In it, we've got the cycle of creation. And in that cycle of creation, it outlines the process to take an idea to a concept to a framework that you can now delegate to eventually a product, service, or experience in the marketplace, but profit up front. So the first one, buying a business. Second one is real estate. Third one is intellectual property. And the fourth one, it's people. People are the only real or true assets. So much of the game is won when the team is picked. One of the greatest teams you can ever have is a great tax and legal team. Why? Because most people are tipping the government. I mean, if you want to check something out, go to wealthfactory.com/tax. You can actually gather resources to support you in building that team. If you already have a large income, or you're working to get a large income, you're absolutely going to have a significant partner. That partner is called the government. Not always the most welcome partner. And so many people are paying more than they need simply because they don't have the right team. See, they're getting plenty. The government's taking property taxes and excise taxes like gas tax, there's sales taxes, just to name a few. When we look at the income tax, and there's so many ways that people can pay less in that, they just don't know because they don't have the right team. It can make a massive difference in your bottom line. For example, if you don't know about the Augusta rule, which is a way that you can write off your home 14 days a year, or if you don't know about D-pad credits, and it's something you go back and look at to find out if you've overpaid on intellectual property that you might have created, or if you don't know how to differentiate your income by choosing the right corporation and avoid self-employment tax, or if you've never heard about 199A, those are just a few things where I'm assured you're overpaying tax and now you're in the know. So that just reminds me of a quote from Pixar, right? So here's the deal. If you have a good idea and a mediocre team, they're going to screw it up. If you give a mediocre idea to a brilliant team, they're either going to fix it or throw it away and come up with something better. So Pixar works to hire the best people and then give them difficult challenges. You don't have to go it alone. Utilize the knowledge and expertise of others so you can go further. Will stocks get you where you want to go? How about bonds? How about the diversified portfolio and retirement account? Not even close. These are the 4 assets that will make you rich. And if you don't know about them or invest in some or all of them, plan on some slow, tedious disappointment with all of the retirement planning out there. It's just riddled with failure and risk. So utilize these 4 assets, apply what you've learned here, and they're going to make you rich in a very short period of time versus 30 years. The way money is raised for businesses or new projects within a business is completely wrong. The traditional way is all about taking all this time to go out there and try to meet with people and convince them to invest in a product that they're never going to utilize. They're just simply investors, and they might have a completely different agenda on how quickly it returns and the amount of time you have to spend with them and the management philosophies. And so you give away a lot of that control. It creates risk. Because you have this end user on one side and a different time frame of maybe when it can be developed or benefited by them versus when the investor wants to be paid, which might be too quick to market, which might create a lot of pressure and stress and infringe upon every great part about your life. What if the investment instead was made by the end user, the person actually benefiting from what you were creating? See, there's projects that failed because of going through the investing cycle. There's a big one right now about the woman from Silicon Valley that created the very micro blood tests and, trying to tell people, oh, it's going to be okay and we're going to get there. And it just kind of eventually collapsed because they were so excited about the story that there's a lot of kind of things that can happen along the way that they're not connected to. So let me break down 3 alternative ways to fund a business. So if you've never started a business, you want to do a new initiative within a business you currently have, or you want to take your business to a new level, I'm going to give 3 specific examples, beginning with my friend, Dr. Chris Zano. Dr. Chris Zano understood coopetition. It's a concept I really talk about in Killing Sacred Cows. Competition is how do we destroy everyone else? How do we eliminate them? How do we remove them and keep everything for ourselves? And that kind of hoarding mentality of scarcity, it can become something that destroys wealth and makes people a bit unpleasant. But with Dr. Zano, he is one of these guys that had one of the biggest clinics in history in North America, really in the world. In Woodland, Texas, he was seeing up to 3,400 people in a week out of one clinic. How did he have this extraordinary feat? Well, rather than just serving those patients, we talked about moving from business to customer or patient for business to business, which was coopetition. How could he improve the entire industry? How can he help other doctors out to see what's possible, to break through limitations just like Roger Bannister did when he broke the 4-minute mile? No one had ever done it, but after he did it, it started to become apparent and available to so many other runners, and that's what I looked at. How could he improve the industry B to B? So he created 2 programs. One was the Zano experience, where he went out and said, hey, you can come and see exactly what I did and exactly what I do. We'll show you behind the curtain. You can go watch it as it actually occurs. In that Zano experience, they could go meet with his team. They could watch him with patients. They could sit through the clinic and see that volume go through. And the second thing is being successful has so much to do with your mindset, has so much to do with your mentors. So he created another program called the Cairo Thought Leaders, where he took 5 people, including me, filmed these videos, gave it away to the profession, had over 10,000 people jump in and say, I want to be part of that, ended up hosting events off of it, and even promoted things that benefited his life, where he became one of the top affiliates, where that wasn't even his intention. It was just a byproduct of value and a byproduct of success because of what everyone wanted. So he took what he was already doing, but he expanded it and shared it to improve others' lives. Let me use another example here. One of my really good friends, the head of my board of trustees, he's written several books. His name's Rich Christensen. Zigzag Principle, Bootstrap Business. He understands relationship capital. When he was writing the book Bootstrap Business, he decided he wanted to have this live case study, so he created a company called Castle Wave. And he did this with less than $5,000. That $5,000 booked tickets and flights and basic pieces just to get the business started. And then the rest of it was relationship capital. He went to Time Warner and he was able to build out search engine optimization for them and some of their artists, including back in those days, P. Diddy, Puff Daddy, whatever his name is, right? Because of the relationship capital that he had other companies he worked with and for, whether that was About.com or the president of Mitsubishi Electric for North America. And so he took those relationships that already knew and trusted him, and he's able to tap into that and have them be the ones that funded the business through the value and service he provided right there to the end user. Therefore, he didn't owe the money back. He actually profited first. He profited up front without investing more than $5,000. I get a little excited as I talk about this. See, there's this value equation out there. And if we want more financial capital, that's a byproduct of 2 more precious forms of capital. The first one being our mental capital. What do we know? What's our wisdom, knowledge, insights, tools, strategies, systems, all these kind of things? That's our mental capital. What are the unique things that we see in the world where we can provide value with? Then when we multiply that by our relationship capital, who do we know? Right? Who's in our life? Customers, subscribers, mentors, family, friends, whatever that is, that's our relationship capital. And the bridge between those two is business. And that bridge consists of serving others, solving their problems, and delivering value. And the more value we create, the more money we make, because dollars follow value. So if you are having a money problem, it's a mental or capital issue, right? Mental or relationship capital issue. Either you're not thinking correctly, or don't have the right information, or you don't have the right people in your life. So you're one idea or one relationship away from the next level of prosperity. And here's a way that you could win first, then play. What I mean by win then play is most people play not to lose. They just sit on the sidelines, they're scared to get in the game, I don't know what's gonna happen, and they just wait and they hold out and they budget and they scrimp. There's other people that play to win, and they say, at all costs, I'll work harder than anyone else, I gotta be perfect, I gotta do everything, and no matter what, I'm never satisfied, right? It's this kind of, everything gets decimated at all costs for them to get that successful win of making money. Well, win then play, it's not this old model of raising funds, which is play to win, hoping that you get that cash and it all turns out so you can be a hero and be on a magazine, but instead it's that you build fans from the people you serve. You win first by taking an idea. Like when I had the idea to write Killing Sacred Cows, I reached out to everyone that I knew and I said, what about this book? Would you like to be part of the readers group? Would you like to give feedback? Would you like this DVD back in those days? Or would you like these teleseminar series I'm doing? If you buy the book up front, then you get these extra bonuses and you get to be on the inside, and then you'll get a physical copy when it's done, which took 9 months after that, right? So I started to make that money up front, got $22,000 to buy people over that 9-month period of time off the idea, knowing that they're going to get it on the other side. So I looked at the simplest thing I could bring out first, which was a recording and a video and just capturing something and then giving it that up front. Then doing a teleseminar series, going through each chapter as it was being developed and getting their feedback and discussing that. And then they got the book. So they got more because they bought early, right? I even did my first video series. We had $150,000 come in because we did a survey. What do you want in this video series? Would you like it at a 50% discount because you become the beta version? You get to see it as it's being developed. You don't get it all up front. You get to tell us what you want, and that's the exchange of why you pay less, is that your feedback is valuable. And then we have this money come in before we film the first day. So we're not borrowing money. We're not raising capital. It's the very people that are the fans and the end users that bring the money to us. And so we're not taking all this risk because we already know there's an audience. They already get to say what could be more valuable for them. And it creates massive accountability, because sometimes me and the other Garrett were filming when we film this, and beads of sweat because it's 1 a.m. and our audio guy doesn't want the air conditioner on. And we've been going for hours because we had a commitment to bring it out. It wasn't being filmed for no one. So whether it was the book, whether it was doing the video program, or even the things I didn't do. Like when I went out with one of my mentors and we were creating a program, and I said, before we create this, let's test it on this stage, because he was mentoring Harv Eker. And if it goes well, then we can finish it out. Let's just build an outline. Well, it didn't go as well as we thought, because we didn't really jive on how we presented when we were trying to share the stage. And we went over time. We didn't even get to make an offer. So I was glad we didn't film and take all this money and spend all this time. We just simply said, here's the idea. If you want in, you can jump in today. We didn't even get to make that offer. I got a free look to see, hey, this isn't someone I want to work with on this level. I'll work at him on the mentorship level. And that saved a boatload of time. So the new way money is raised for new businesses and new projects, right? It's completely different. The old way is so wrong, so risky. They end up getting their rules. They end up owning you and your life and your time, and it's disconnected from the end user. But now you have this knowledge to transform your thoughts into profit. Thoughts into profit, up front. The NFL won before the Super Bowl was played. They already sold out, right? They already won before the game was even played. The NFL experience. This is an amazing way. When the Statue of Liberty came to New York, it would have just been floating around out there in the Hudson, but all these people up front paid to be the first visitors. And that built the concrete barriers in the visitor center, so they were already excited. They were already anticipating, which moves quicker, which gives you feedback, which they feel like they're part of. And people support that which they feel they're part of the build.
Let's talk about how do you find these companies, okay? Let's go with the biggest mistakes. They're actually intertwined, okay? The thing is that 9 out of 10 people that start looking for a business to buy are never actually going to pull the trigger on anything. Okay, it's a crazy statistic. It parallels that of startups, right? And I think it has mostly to do with mindset. In other words, if you are an investor and you're looking at, a startup business and they sort of come out and pitch you, right? It's like, here's my slides, here's why you should invest in me, here's why you should give me, your money. And a lot of that kind of transfers to, and when you're making, stock picks or anything like that, it's this sort of like, sell me on the opportunity and then I'll spend my money. A lot of times, first-time buyers have the same kind of mentality when they go out looking for a business. They sort of sit back, put their feet up on the desk, and they're like, all right, why should I buy your company, right? And the concept is actually reversed, right? You need to pretend it's an interview, that you are the CEO you're interviewing for the CEO job, okay? Like, someone who grew their business from scratch. It's their baby. It probably put their kids through college, or, has basically it's the biggest asset that they own. They don't, like, the money needs to make sense, but they're going to make a decision on all of the qualitative things that come along, okay? So the first is sell yourself, don't look to be sold, okay? Number two is work with a sense of urgency. A lot of people are like, hey, this will happen when it happens. I'm looking for that, gold nugget or whatever. And they're not working with a sense of urgency. And if you set a goal for yourself of like, hey, I'm going to buy a business in the next 6 months, that's really aggressive. That means like you need to find that company in the next 90 days and you need to start the closing process, okay? And if you're working with that sense of urgency, you will find your opportunity. You won't sit around and wait for, that absolute perfect marriage, right? Like when we're all like children, we think there's like one person out there for us, right? By the time we're 40, we realize, there's probably a couple dozen people that would have worked.
Your poor wife, dude. I mean, I'm a premier romantic and a hopeless romantic. And so I believe, I met the one person that could tolerate my BS and still love me somehow.
That's true for you, but for most people, right? Like it's sort of a life decision that happens at a certain time. You're a little, you're a little 1%.
There are 8 million people out there, so yeah.
And so the thing is there's a lot of relationships that could work, right? There's a lot of businesses that make a lot of sense, right? And the thing is like understanding the underlying drivers that are important to you and the growth opportunity that is right for you and what you bring to the business is the little thing that makes the big difference, okay? In other words, most people will look at a business opportunity or an acquisition opportunity as sort of like what's on the menu, right? And
if it's a great business, other people are probably going to vie for it. So that's treating like an interview, like bringing the best you have to the table, critical.
They go into the restaurant not knowing if they want chicken or steak or pasta or if they're a vegetarian, or they don't even know what they're looking for, right? So finding out what it is that you bring to the table as a CEO is the thing that's going to help you identify what's the right business for you.
And what kind of things for people that have never owned a business before would they need to prepare for? How complicated in your mind is it for someone who's never owned a business to run a business? Like, is there things that you would do if you had never owned a business to do this right? Were there resources that you would read or people that you would seek out?
Yep. I mean, saying you're going to buy a business is sort of like saying I'm going to go get a job. Like there's so many different types of companies that it's impossible to answer the question. What I would say is that, I make money a few different ways. One of the things I do is I work as a business broker for online businesses. And I think that online businesses have a high degree of transferability. So they're easy to buy and they're easy to sell. And it's also kind of like business light. In other words, they tend to not have 35 employees, at a manufacturing location with all kinds of capital equipment and things that can go wrong. And so the more people you add and the more pieces of equipment you add, the more increased complexity there is, right? And so there's kind of there's just kind of let me answer the question this way. Search funds have become very popular in MBA programs, right? It's the number one, entrepreneurship through acquisition is the number one elective MBA class at every single school in which it's taught. But it's only taught at 11 schools, okay? And the concept is search funds. So MBA students basically getting financed by these, institutional capital firms or angel investors to go out and find a business and buy it and run it, okay? And the thing is I've often questioned, is that a good idea for a newly minted MBA to run out and buy a company, right? And the thing is that I thought I was ready when I graduated with my MBA. What happened was, it was, I found the private markets. They're opaque, they're fragmented. It takes a while to figure it out. And so I spent a couple of years looking, but during that time I had a couple of jobs. And Garrett, I just want to tell you, I learned more like just in my mid-20s, like out there doing it, like actually trying to sell things, actually trying to, manage teams of people, actually trying to, run production, that like I got to actually like break things on other people's dimes before I ran out and bought a business.
So working for the type of business that you might look to, acquire. So going back to your menu analogy, chicken, steak, vegetarian, like once you identify this is what I'm going to acquire, then you uncover your investor DNA, like how you understand how you would run that, learn from those people. Even if you're paid less than what you want, be paid with that education, be paid with that information, be paid with that insight. And then, especially if you were going to work for somewhere that wanted to sell in 3 years, go ahead and put yourself right into that purchase.
That's right. So I think like understanding what you bring to the table, working with a sense of urgency, and really understanding that you're applying to be the CEO of this company are sort of like the three things that make the big difference in initiating a search and actually closing on something.
Yeah. So the mistake would be not knowing what you're looking for.
Yep.
Going into it before you're ready. Not knowing what would make you ready or who to learn from.
Yep.
And then, just not knowing where to search would be another mistake. Jumping into something too early would be another mistake. Trying to do too much alone.
Yeah, let me so when you get into like I would say once you actually get to LOI, like what letter of intent, and you could put in an offer that's accepted, the mistakes that happen after that are, it's sort of like do your due diligence. It's kind of amazing to me how many people are sort of laissez-faire about their diligence, and what that means is it translates.
We've already bought into the idea before we've done the analysis. Like I already know I'm going to buy it, so I stop looking at due diligence because I'm convinced.
That's it. And
I'm just speaking from my experience of acquiring a business. Just saying.
Yeah. No. That's it. And the thing is that like this is how it actually surfaces. The day before closing or the week before closing, it's like, I don't know. I just have cold feet. Like I just feel like I can't close it for some reason. I don't know. I'm not comfortable. Well, you're not comfortable because you didn't do your diligence, right? Like if you actually jump in and do financial and legal and operational diligence, you're going to be very comfortable. Now, there's always a leap of faith. It's always a little nerve-wracking, when you're taking out a big loan to buy something that like its destiny is dependent on your ability to actually create the future you're after. But the thing is like do your diligence and just prep, right? And the only other thing that I would say is it's not exactly a mistake, but it leads to one, which is a lot of first-time buyers really don't understand that most sellers are not evil by nature. In other words, they think that they're trying to dodge some kind of bullet, or like, oh, if it's so good, how come they're selling, right? And the thing is that like, probably a percentage of people are bad people, okay? That leaves 99%, okay? When you go to sell a business, it's a natural part of the life cycle of entrepreneurship, okay? Like, number one, we build something of value, okay? And it's a value, and then, we get it to a certain point, doing what we know what to do, and then it sort of starts to flatten out. And as entrepreneurs, we all kind of have shiny object syndrome to some degree. And so you get sort of on to the next thing, and like you start, planting seeds, and then you're like, wait a minute, I can do this, but what I really need to do is sell this company first so that I can focus on the next thing, right? And so you've created something of value, and it's time to sell, right? It's time to exit. It's time to sell it to someone to take it to the next level. At the same time, if you look at that growth from like 0 to 1, if you will, when you're starting a business from scratch, and compare it to, buying a company with, if you use a lot of leverage, put a small down payment in, the curve is very parallel, right? Like you're building that equity in the company almost at the same rate, especially if you can grow it, right? And so it's just a part of the natural life cycle. And then once you have run your course, it's time for you to sell as well.
So, and that's part of the acquisition entrepreneurship goldmine is if you have new insight, new energy, a new person, there's definitely some break off in that, but there's also a possibility for breakthrough, for bringing that, energy to it. So where do people find businesses? Like, you're a business broker. Like I pretty much just tell people, business brokers. I mean, do you have a better answer than that?
No, I think that's the best place to go, frankly. Look, there's a lot of attention. Once you break into like, okay, what is acquisition entrepreneurship and how do I do it? You'll see there's a lot of noise around proprietary deal flow. Ooh, what that means is go out and talk to everyone you know, okay? And try to dig up a deal, okay? The thing is look, I spent a lot of time trying to do that myself. Off market deals happen all the time. Okay, it happens. But number one, every business owner who hasn't talked to a business broker yet or gotten a valuation, or business broker, by the way, can be called intermediary, investment banker, M&A advisor. It doesn't matter. Okay, if they haven't talked to someone and sort of gotten a valuation and understand the process, everyone knows that their business is worth like 20 times EBITDA. Okay, and that's not how the private markets work. But
and EBITDA, for those that haven't heard the term, you hear it a lot, especially in this type of transaction. It's earnings before interest and depreciation and amortization, right? Amortization. So basically, it's looking at a more clear picture of what the profitability or revenue is after certain expenses are taken out or certain things have minimized. So yeah.
Indeed, it's an attempt to neutralize earnings independent of management decisions. Like if this business is a box, like how much cash does the box generate that I can use, right? Like that's the concept. So 20 times EBITDA would be okay for a publicly traded firm with $1 billion in revenue.
Yeah.
For $1 million business, you're probably looking somewhere between 2.5 times and 4 times, right? Depending on
10 to 20% of what they're
Yeah. So
another reason why I'm excited for small businesses, because I'd rather do 2.5 than 20. Like if I'm buying a small piece of a publicly traded company because I own a share, well, I'm buying that and I'm basically saying it's worth 20 times more than what I'm paying for it, essentially, right? It's
like a 20-year
potential and where it's going to go to. Or if I'm buying this other business, I'm like, I'm buying it today for 2.5 times what the EBITDA is, which is different than even revenue. And so it's just there's a lot more upside potential or immediate cash flow, which most stocks don't produce a lot of cash flow, but a private business could. I've interviewed some of your clients and, that made it profitable after 30 days and had a really good stream of cash flow after 90 days or 180 days. So, and part of it is they had expertise in that arena and they focused on some things that the other owner just didn't know about, because a lot of these entrepreneurs are good with ideas and starting something, not good with managing it and the details behind it. So, and what I find is a lot of people that aren't business owners are very detail oriented. They usually work in an organization rather than start something. So, in the Myers-Briggs world, like an SJ, like a methodical, less likely to start a business, but maybe the perfect candidate to buy a business and improve everything in that business, right? So just as an idea there.
This morning I was talking with one of the members of the acquisition lab that I run, and she was asking about, we were talking about, the book Traction. Gino Wickman, right? Yep. And Gino Wickman has the visionary integrator dynamic. And what I want to tell you is I read that while I was CEO of a book printing company. Okay. And I was like, I don't need I'm the visionary and the integrator. I can't afford a visionary walking around, and I also can't afford to leave the business and just walk around being the visionary. Right. So I had to be both. And so what I came up with before I read the book was actually revenue generator or profit maximizer. Okay. And I feel like if you're in not a high growth business or you're in more of a mature business or something like that, I feel like you kind of resonate in one of the two places. And then along the way, I've sort of realized that in high growth companies, the visionary integrator roles really make a lot of sense. And so I came up with this idea that they actually overlap with each other and you end up with quadrants, right? And it's sort of where do you fall and what's the right business opportunity for you? So to your point, there's a ton of people out there that just want to manage a going concern. And, if you take this sort of 3x, multiple of EBITDA kind of earnings of valuation that we're talking about, Garrett, what you're talking about is, putting 10% down on a business, getting a 90% loan on the business, and then off of the price, you're making a 30% return. Okay. And then you cut that in half if you maximize like the loan, right? So you're still making like 15% on your money right away. Now, the argument against that is like, yeah, Walker, that's great, but I'm putting my time in, right? And so I should be making a salary as well. Yeah, you are, right? I mean, this is your salary, but the point is you also get the asset. So you're working your cash flow statement, you're working your personal income statement, and you're working your balance sheet simultaneously.
Yeah, you have more control over the outcome of your income. You have more influence. And I think this notion of passive investing, where we just give people our money and then money comes in every month, is a faulty notion. The reality is the more active we are up front to buy an asset that can continue to generate revenue, the more passive it becomes over time versus just watching our money pass us by. And this is the travesty for humanity, is that we've been taught, trained, and educated, hand your money over, wait for 30 years and it's all going to work out. Well, 95% of the time it does not work out. So I like this because you can look at the predictability of the business, the financials, how long it's been around. And, I'm thinking of two people that weren't business owners that read your book and bought businesses, and they're doing great. It doesn't mean there isn't trouble at times and they don't have to get involved. And there isn't, yes, it requires effort. When we think there's something for nothing, we're being robbed of our livelihood. It doesn't exist. There isn't mailbox money for 99% of the people or 99% of the time. Even if you're part of the lucky sperm club, meaning you were born into the family, you still got to behave a certain way if you want to still get it. If you're going to win the lottery, you're one in however many people that actually win it. The rest of the suckers are just giving their money away. And if you marry into it, that's probably the hardest work there ever has been, to be able to get money, because now you got to fake that you love someone, and that's a pretty tough thing to do. So I look at this as a much better alternative here, right? So Walker, thanks for answering those questions. I got to have you back on to Ask the Money Nerds because we did get more questions around this. But I will say I don't endorse a lot of books because, first off, I only endorse books that I read. And what most authors do is say, hey, I want you to endorse my book. Can you have it to me by Thursday? And it's Tuesday. And I'm like, well, I can't. But you actually got me the book, got it to me on time. I read every page of the book, and I personally wrote the endorsement. Now, I don't know if you massaged it or made it better, but I did write the endorsement that went into the book. And then I endorsed it so much that I bought a bunch of copies. We handed it out to clients, and I consistently introduced Walker to people and connect them into my team, because this is an important part of our future when it comes to investing. And a lot of the financial people out there don't get paid on a transaction for you to buy a private business, including my firm. We're not paid on that. I don't care. I'm here to make sure we're doing the right things so that people can get ahead, because there's going to be a major transfer of wealth. And this is one of the three avenues that transfer happens. Make sure you're on the right side of that transfer. You can help out your employees. You can help out, the people that are your customers, rather than just watch your money dissipate when you're in an overinflated stock market that has no accountability. So, Walker, any final words before I bring you back on and interview you again?
I would just say that this is entrepreneurship. It's not easy. To your point, it's active investing. Okay, so you can be active and uninvested, like at your job, or you can be invested in passive and enjoy your $1 a month return, or you can combine them together and create something that is truly special and built around.
How do you go about acquiring assets? And maybe I don't think responsible is the right word, but how someone's into real estate. How do you go about doing it without really putting so much risk into it? I know you have a friend who wrote a book about buy then build, right?
Yep.
Can you speak to that a little bit? I think it would be helpful.
So in real estate, the first thing I would look for is, how do you make money on the buy? So an example that I lucked into where I made money on the buy is one of my friends, Joe, called me and he said, hey, I've got a friend that is not making his house payments, but there's a lot of equity. At the time, there was $90,000 of equity on basically a $280,000 home. So he's risking losing it and going to foreclosure. So I came in and I bought it. We used my wife's credit, no money down. We bought the property, and then he started making the payments to us while he lived in it. But he worked on his credit over the next year, and then he bought it out. And we were just going to split the equity at the time that he bought it out because I helped save it. So I actually walked away with $90,000, and he walked away with $90,000 because the market was so hot at the time, right? Wow. That's making money on the buy. There's already equity there because of a distressed situation, a distressed seller. We did another Ask the Money Nerds question where someone's got a bunch of equity in their home, like 40% equity in their home, but they can't qualify for a loan. That might be an example, right? Mm-hmm.
where they could,
For sure.
yeah. So how can you make money on the buy? Some people do it because they know if they just, improve some amenities, maybe they improve the master bath, maybe they improve the entryway, maybe they improve the kitchen, that they immediately know someone's going to find more value in that, right?
Yeah.
So some people are good at the fix and flip, and there's formulas and there's software that are just really effective. It's competitive, but know what you're doing. So how can you make money on the buy? The second way you make money on the buy is at cash flow positive from day one. How can you buy it and it's already cash flowing the day that you get it?
What kind of situation would allow a property to cash flow from day one?
The right rental agreements, right? For a commercial property. So there's already lease agreements, and obviously that's going to drive the price up, because in commercial they look at the cap rate, which has to do with the rents versus what you purchase.
Okay.
And so obviously people know what they're willing to buy based upon that. Let's say that you went and you bought a 30-plex, okay? But it was just zoned as a 30-plex, but then what you do is you build it that each unit could be individually sold. So it's not, and then you go to your tenants, and maybe 30% of them want to buy that unit, and all you had to do is make some modifications for it in order to qualify for financing, and all of a sudden, okay, you've got a great situation because you could sell that, refinance, have a loan at a place where everyone else, or you could even sell or finance to your tenants, which might mean they make a down payment. You're the bank. They're paying a higher payment because now they're building equity and you're the lender.
Wow.
So these are just a few examples of what you might be able to do. Or maybe you have a really great property and you make it a corporate retreat, and all of a sudden you're renting that for short term. See, because when you rent something for 12 months, it's going to be a much lower monthly payment than, let's say, we're close to Park City right now. During Sundance, you can really rent for high during that week because of the demand, right? Or during ski season, when it's a great winter like it is this winter, you can rent for a lot more for those short terms, rather than, and now it's more work because there's more turnover and there's more management, but that could be a big boost in cash flow as well. So you make money on the buy because of a distressed situation, or you know what you're buying that someone else didn't know, or maybe it's someone's now deceased and it's part of an estate and they're just trying to, move quickly and get their cash. Like the cabin, that's what happened here with this cabin. It's cash flow positive because you have the right renters, or you fractionalize the ownership and now you've got 8 different owners and they're all leasing it out. There's so many options there.
Yeah, I have to say I'm learning a lot.
Yeah.
I know my investor DNA is not real estate, but this is exciting stuff.
Yeah, so make money on the buy, be really cash flow positive. And this is what I would say. You have some type of due diligence team or formula, and you have to look at a lot of deals. So if you're going to get in real estate, treat it like a business, not like a hobby.
Yeah.
Because otherwise you're going to be with really competitive, intelligent people that have software and have teams, and that they'll pass up on a ton of deals to find the right deal. So if you're patient, you're looking at enough deal flow, you're going to be a lot better off. And so, I'm a instructor for some of the real estate programs out there, and you'll just see there's so many things to do in real estate, from lease negotiations to lease options to seller financing to auctions to commercial property to residential to vacation rentals.
My
I mean,
goodness.
but don't try to be an expert in all those things. Find what it works for you.
Find your lane and stick with it.
And you could be a little bit more passive and get involved in real estate syndications where you're an investor, or REITs, real estate investment trusts, where you're just buying into a fund, but you'll have less control. And those don't always go according to plan, so you better be really clear about it, or the really good ones may not pay as high of a return unless you're a very wealthy family and part of the accredited, investor type of arena. But, there's active and there's passive, and, there's a lot of difference in how much time it's going to take.
You lose speed in your business when you have to borrow money or go out there to raise funds. Why not instead have your customers finance your business instead of the bank? Look, you can create momentum without debt. You can actually have the people that love what you're offering be the first ones to buy it in a beta version, meaning you can pre-sell it before it's even done. You can be profitable before the idea is even fully developed, and moving forward, having the people that wrote the check give you the feedback and tell you whether or not it's good or what improvements they'd like to see, and then they can start telling other people about it. So the issues that arise from using a loan is, first, you're paying interest. So you're not earning interest, you're paying it to someone else. You have a time loss because you have to go out there and qualify for the loan. I've seen people that take up to 6 months to go get some loan that they qualify for from the SBA, the Small Business Administration. They're getting all the documents. I think they have to give them blood by the end of it. I mean, it's crazy because you have to give your taxes and your credit score. And certain types of loans can actually negatively or adversely impact your credit score. And therefore, when you go get a car loan or a credit card or a line of credit, you might end up paying higher interest rates there as well. See, when you go borrow, it might even put your assets at risk because they might use those assets as collateral. I made a stupid mistake back in the day. I decided, hey, how do I know that it's moronic to get a loan? I went and got a loan and I did it with a personal guarantee. When I went and got that personal guarantee, and then all of a sudden my business partner went bankrupt and couldn't make payments anymore, after 5 years we had a balloon payment on it. The bank came to me and said, hey, you need to pay this off. I'm like, well, I don't have the cash just to write you a check today. Like, well, then we're gonna not only foreclose on this, we can go and attach to your income and your assets to do that personal guarantee. I was like, wow, that put my assets at risk. Fortunately, I figured out what to do and made it through that situation, but there was a lot of sleep that I lost. That's where I got the gray hair during that time. You know what I'm saying? So this can even harm your cash flow because when you have to pay that loan back, those interest rates could go up if it's on a variable rate, or you might have to make a payment at a time where you have a cash crunch because businesses have those things happen. And maybe this is a new initiative, new product, new service, and it didn't go as quickly as planned, or you had a merchant account issue and all of a sudden you couldn't get everything done at the time that you wanted. I mean, that's the thing about business. There's plenty of we don't even know what surprises are coming our way. So what if we could just start putting the odds in your favor rather than taking on risk? Yeah, the institutions, they're gonna win, but do you win? See, if you build your business on connections instead of loans, you're gonna massively lower risk and you're gonna improve cash flow and you're gonna be able to sleep better at night and be wealthier. I mean, I think that's like a win-win-win-win-win if I keep going. Here's some examples. There's this company called Coin. You could put all your credit cards on one credit card. And I paid for it before it was even done. And then I just watched and they gave me videos and talked about the process. And so they were making the money and they were inventing the product with the end users. If you go to Indiegogo or Kickstarter or GoFundMe, I have a really good friend, Jeff Hayes. He's done documentaries, one that really impacted my life. And he actually put it up on one of those websites that do crowdfunding. And so people, if they put in enough money, they get a certain number of downloads or DVDs, or if they put in more money, they might get an executive credit, or they might be able to see part of the process. And so you have the people going, wow, I love what you're up to. Let me write you a check for it. I mean, I look at this like exactly what sports teams and concerts do. You pay for the event before you even see it, before it's actually even happening. It's just been reserved at a certain date. You can do that in your own business rather than going out and make a stupid mistake with the loan, damage your credit, not be able to go get the home that you want in the future, have stress upon your marriage if you're married, and start to feel more like a failure. No reason to feel like that. You've got value to offer. You've got people that want that value. Let them pay for it. When I did my first video series, we got $150,000 raised before we even started. We went out and said, what do you want to see in the video series? Those people that responded, we called and said, we'll give you it at 50% off because you won't have it all up front, and just give us feedback, and we even got case studies. See, there's another name for starting your business on customer value over bank loans. It's called win then play. It's my mission, my purpose, my mantra. When you get the money to start it from the people who want it, you're winning right out the gate. Here's 3 steps I use to win before playing. The first one is getting that customer feedback through surveys. Just like I talked about with the video program, right? The customer's feedback builds your business, and you test these ideas on the very people writing you checks, not just family and friends that love you, but people that are actually using it. And value comes from their experience. When we created Fast Track on Demand, they said, we actually want tests. We'd like, a guide that we could follow along with. We want transcripts. We just started to build more, which made the program more valuable, and they started to utilize it. Okay, the second thing is get customers to pay for this beta version up front. They write you the check knowing that it's not even created. Maybe it's just outlined. If you've read the book Lean Startup, or you understand about MVP, minimum viable product, you're just looking at what's the first rendition you can offer. You pre-sell that. The people that write checks, they're the ones that are telling you, hey, this is what we want, and you already have end users before it's done. Use those funds to build it, not bank funds. When it's all done, you don't owe any money, you made money. That blows my mind. I love this process, right? And 3, once you've got the feedback, once you've got the beta version done, and now that it's built, now you can do an official launch. So I did 22,000 pre-sales of Killing Sacred Cows, mostly to financial professionals that love the book and want to put it in clients' hands. And then when it was done, that's when I started to do my media tours. That's when we started to, do everything we could to get this in everybody's home possible so they can overcome financial myths and improve their life. So after you've built it and after you're profitable, now you can do that official launch. So after this, if you go out and start your business on a loan, it's moronic. Make money on the buy. Create momentum with the users who will benefit from your business. Win first, then play. You can make money and be miserable. You can not make money and be miserable. Or you can make money and be happy. What is the difference here? This is the fourth and final video on the Soul Purpose series, but despite all that you've discovered, if you don't simplify your life, you'll never amplify your results. See, when Steve Jobs came back to the financially sinking Apple in 1997, his main goal was to cut nearly 70% of the product line. Focus instead of diversification. Where can you be the very best? You can keep busy being busy, or you can be on target. You don't get a second chance, and every moment you're not on point with your soul purpose is an opportunity wasted and a life squandered. We have this famous rap artist that we work with at Wealth Factory, and he just saw an abundance of opportunity. The more famous he became, the more he was writing songs with amazing people and having his own albums take off. There were just people that were coming up and they're like, we could do this and we could do this. And so he saw that as opportunity. The reality was, a lot of that was just distraction, removing him from his talent, being busy and making money, but not making as much as he could, doing the things that he was very best at and most unique at. So if he didn't get on target, that was going to be a plethora of destructive distractions. So what can you personally do to simplify and focus on your soul purpose? This stairway will help. It's a stairway to get right to the center of the target. So let's begin with this question. You can go to wealthfactory.com/solution, and this will be the fourth section on that workbook that we're gifting you and giving you for free as a guide to go along with this. So if you could only do one thing to earn an income, just one thing, what would it be? For me, it would definitely be speaking and sharing, right? If I could do two, then I'm definitely adding writing in there. If I do three, I'd be building out content for other financial people and a lot of workbooks to kind of implement what I'm talking about. But if you could just do one thing, what's that one thing? And what one thing will you immediately do to start cultivating your soul purpose? See, I have a publisher, Bard Press. They actually did the one thing, and they did my book, 5-Day Weekend. And it's funny because I wrote all of this before that one thing came out, but that is such an on-point book at getting you focused instead of diversified. So when you look at the one thing you'll immediately do to start cultivating your soul purpose, what is that? Share this with someone that can hold you accountable, or place something in the comments so that we can support you and engage with you. All right, let's go to the next piece. Is there anything you enjoy personally as a hobby, interest, or the like that can be productive in your business life? I'm now integrating in my Win Then Play keynote examples I've done on stage at comedy places, but then translating it and saying, how can I make this connect so that people can laugh, they can have fun, and also I improve my ability as a speaker going into doing stand-up comedy. To find the time to live a life you love and make your greatest impact, is there one person or situation that you can address right now because it's creating an energy drain? Is there just one situation or one person? Maybe your finances are a mess. Maybe you have a wrong employee if you're a business owner. Maybe you have to have a conversation with a loved one that there's been an issue or a fallout, and that's starting to drain your energy and weigh heavily on your mind. I know it's not always easy to have these conversations, but we want to be hard, easy versus easy, hard. Do the hard things now and life gets easier, or do the easy thing now and neglect it and wait, but then it eventually blows up. It's kind of like course correcting over time versus a forced correction like bankruptcy or elimination of the relationship. So next piece is, what if you could only make one improvement to live your soul purpose? What would that one improvement be? It's going to put you on target. Here's the key though. Spend 20% more time on that one thing over the next month. 20%, this is the Pareto. You put 20%, you get 80% better result if it's that one thing. See, you're the author of your life. You're driving the car. So what can you do to make an adjustment to be on target with the life you love? As you look at this workbook that has the Soul Purpose Analyzer, has the Soul Purpose Optimizer, has the Soul Purpose Wheel, and now we've got the Stairway, we're giving you the resources and conditions to discover your soul purpose. Why? Because, well, this is on video. I might not even get to meet you in person or ever see you, so I'm just giving you the resources. And even if I met someone in person, I can't look at them and go, I know your soul purpose. I know what it is. You can do X, Y, and Z. This is a self-discovery process. This makes development personal. Personal development isn't merely learning about passion. It isn't just dealing only with past issues and trying to get past those, so to speak. It's really this process of self-love. It's really this process of acceptance and gratitude. It's a process of recognition of what you can contribute and who you are versus what you're not capable of doing. Far too many of us feel bummed out when we go, oh, look at what they could do. If I could only do that, or if I only have that talent. Well, what talent do you have? Where are you discounting what you can bring to the world and who you are when you're at your very best? And what conditions can you create? What people could you spend more time with? What ideas share and influence and inspire you? Is there a single event that you could go to where there's the right people? Are there publications or audiobooks or podcasts that bring more of this into your life so that we nurture it and that we feed it so it starts to grow? Soul purpose is a lifelong journey. It's an experience of the best of who you are. Now, some might make a lot more money living their soul purpose than others, because some people's soul purpose might have to do with a nonprofit, because that's just one expression. But just because you're really precise with something, you might be a good surgeon, but you might be a good accountant. Soul purpose is not what you do, it's who you are. Soul passions are the expression of who you are out there in the world. And see, there's this whole notion that you can watch videos and they're like, you gotta hustle, you gotta work harder, you gotta do more. And some of that starts to create this playing to win mentality, where we're just always more, and then we wear ourselves out. We lose health, we neglect relationships, shame and guilt start to come in because of those things that we didn't pay attention to. There's disasters that happen because of that negligence. And all of a sudden, life becomes overly complicated. And that's where regret starts to live and permeate within the cells of everyone that's around you and yourself. So what can you do instead? You embrace the best of who you are. And it begins with self-care. It's okay to take care of yourself. There's this misnomer that it's all about every sacrifice for everyone else in the world at your own expense. Well, the less you take care of yourself, the less you have to give. You've got to invest first and foremost in yourself and be really calculated with that and careful to take a daily ritual, to take time to yourself, to take time to think, and to be intentional with your life. And then you want to eliminate those people that don't allow you to love yourself or feel good about yourself, or that they want to be detrimental or say why you can't do something. This is a lot harder to do sometimes than even what I'm saying here, because you may love and care about them, but you can still love and care from a distance. I think the game changer for soul purpose comes down to one statement, and I get it. It might feel just a touch airy-fairy, but it's the reality. It's love. It's love of self to the point where there's so much that you have excess to give. And when you've fully taken care of yourself, that you can shine at your highest level, you can make the massive impact in the world through value creation, serving others, and solving problems, but you can't give that if you don't take care of yourself. You're your greatest asset. Invest in that asset. Develop that asset. Know that skill set. Delegate the things that aren't aligned with your soul purpose. It's okay. That's called investing. That's called prosperity. That's called divinity of diversity. We all have different things we're good at. If we're all good at the same thing, it would be hard to exchange. But because other people can take things off of your plate so you can do what you do best, there's more opportunity there with more enjoyment. I think that people that are in poverty are really, and they're trying to get out of it, when they're trying to do that through effort, it can be frustrating because it becomes about busyness and less about productivity. The middle class gets stuck in that mindset all the time. And look, there's certain advisors. I had an interview with Robert Kiyosaki where he interviewed me for an hour and a half, and we were talking about poor people take advice from other poor people, or the majority, and then they're just handing their money over. The middle class get their advice from someone different, and the wealthy get their advice from someone completely different than that. But the bottom line is, if you don't take care of yourself and someone else takes care of your money, it's never going to be money for you to enjoy. You might spend it just on getting your health back, or you get divorced because of that negligence, and all of a sudden half of it's gone. So feel free to invest in your soul purpose. Go through these workbooks. Start to uncover and discover what's inside of them. And when you see what's inside of you and you bring that to the world, it will be inevitable that prosperity will follow.
A few years ago, I inherited a stock portfolio that has a total value of approximately $300,000. Okay. I don't understand the stock market, nor do I trust it. Welcome to the club, Michelle. As a retiree,
you just trust it more than not trust it. You know enough now being around me. You're fired up. You're calling your family.
I am. I've been trying to educate everybody I know, and they're just like, well, it's low, so I think I'm just going to buy more. And I'm just like, if someone would have just listened to me a few months ago because of what I've learned from
How long
you.
have
You
I
would have been
been
in a better
At the
position.
top of my lungs. It was October of 2019 where I was like, where we hosted a virtual trend summit. We were calling it. I said I was retiring at the end of 2020.
Yeah.
If I was wrong. That's how much of a stake I was putting on it. I was on Fox News with Neil Cavuto, August of 2008, saying the stock market's overvalued. Stop funding your retirement. It's time to move to cash. And people thought I was nuts. And within the next 2 weeks, there was a 14% drop. And then it just went down for 2 more years. Like, I don't know how to predict all this. Let me be clear. I didn't know that the real estate market was going to dive as fast as it did in 2008. I thought it was overvalued. But when lending changes, it happens quickly. When a coronavirus happens, things happen quicker than you can predict, even if you have the most brilliant minds on things.
And even what I'm realizing as I continue to learn about all of this is there are so many variables and you don't know what is going to trigger the downturn.
Right.
And it could just be based upon an emotion or a perception. Like, I fear something's going to happen. So then people panic and make decisions, and there's a massive impact on the stock market.
I read this report one of my mentors sent me. It was from McKinsey, the big consulting group. And they were flat out, I don't know how many years ago it was, but they were saying, we are in for something massive and major on a global scale. It's coming our way. We don't know what it is, but based upon all our models and what we've seen with the history, and I was like, wow, it kind of sounds like sky is falling, but these guys are doing research behind it, and here we are.
Yeah.
Here we are. All right.
Okay, and here we are to answer questions. Okay, so I'm going to start over from the beginning of our question so we catch it all. So Michelle says, a few years ago, I inherited a stock portfolio that has a total value of approximately $300,000. I don't understand the stock market, nor do I trust it. As a retiree living in Southern California, I'm afraid if I pull out all of the money out of the stock market, the tax implication would be worse than keeping it in there. I'm looking for a financial strategist to help me, but in the meantime, do you have any advice that can help me?
I'll go straight to the camera on this one. One, you can go to wealthfactory.com/private if you're looking for a wealth strategist. We have investment advisors, wealth strategists that you could meet. Number two, when we inherit money, there's something called a step up in basis. So capital gain assets like businesses, stocks, pieces of real estate, that can actually transfer and get a step up. So let's say this person that died paid $100,000 for these, and now they're worth $300,000. That's $200,000 of gain. But when it passes on, a lot of times there could be that step up in basis, which acts like $300,000 is what it was paid for. So that would mean that there might not be tax implications, especially with this downturn. It depends on what amount she inherited versus what it's worth right now. So you've got to learn about the step up in basis. Okay. So that's the first piece. I'll let you. Is there anything you have?
No, I don't.
I'm a master interrupter. People tell me all the time. So I'm giving you space. You always have really good insights.
Thank you.
The second piece to this is when we're putting our money somewhere and we don't understand it, we've got to stop calling that investing. The world has marketed to us, whether it's Wall Street or retirement planners, the word investing, and it's first off been collapsed to count savings and investing in the same thing. Savings is we've got money set aside. It's available. It's not earning a high interest rate. It doesn't go down, but it's not going to go up a lot. That's savings. Investing is we're locking it away potentially. It could be volatile. It might have a bigger payoff in the future. There might be certain risks associated with it. But speculation or gambling is when we put money into something that we have no idea. Why would it work? When would it work? How would it work? How does it benefit us? What are the risks involved with it? And if there's no risk management, then it's speculation. And look, institutions do a lot of risk management. Like, first off, if you go get a loan from a bank, they want a down payment. That's risk management. They want an appraisal. That's risk management. They want to see your taxes and your credit score. They want to charge you private mortgage insurance if you don't put enough down payment. They want a lot of information to protect them on the downside. So that way, if you default, they know what the underlying asset is. If you've got a down payment, you've got more skin in the game. If you show that you've had a history of a certain income or a responsibility with your credit score, these are all factors that are risk management. And look, in Wall Street, this is what frustrates me. Interest rates are 0% with the Fed right now. And so now banks can borrow super cheap to nothing, and then they can still lend it out and earn an interest, right? But if they fell like they did in 2008, guess who bails them out, Stolba?
You and I
The
and the rest of the
taxpayers.
public.
So
Yeah.
this is bullshit when people say it takes money to make money. Whose money does it take? Does it really is it the bank's money? No.
No.
They have
They're
our
recycling
money that
our
they're
money.
recycling out. Exactly. Good word. And then they say high risk equals high return. When we put money in a retirement plan that we think we're taking high risk with growth funds, the person that's the manager, they have responsibilities, but they're getting paid a fee. The company that's issuing the talent, they're getting paid a fee on the entire portfolio, not on the cash that they put in,
Right.
but on the portfolio. And if you lose, they still get a fee
it.
on whatever is left over. They're not taking high risk to get high return. It's not taking their money to make money. And yet these faulty notions have rigged the game against people. They rig the game against people because first we neglect cash flow. Second, we take on unnecessary risk that we don't understand the nature of that risk until we have a crisis like we're in today. And then it just frustrates and creates bitterness, right? We have people that have high interest rate loans, yet they're funding their 401ks. Pay off those loans. We have people that are funding 401ks and retirement plans before they've even put 3 to 6 months of their own personal savings or before they've invested to figure out their own skill sets. This is what's frustrating. Now, this question about inheriting, like, I love that she's just willing to admit, like, I don't know what I'm doing. I don't trust the stock market. Great.
Yeah.
Then it's time to figure out where you're going to invest. You've got to learn your investor DNA and understand, what do you understand? Some people are great at real estate. Some people are terrible. A few people are good at stocks. Most people are terrible. Some people are good at businesses. Others are terrible. So if you don't know to invest, I think you got to look at things more like cash flow banking that have security and stability.
Yeah.
And you got to look for things that have more fixed interest or fixed income, which unfortunately with interest rates so low isn't really exciting. It's not really great. But it's better than losing.
Yeah.
And it's better than losing sleep. And it's better than feeling this frustration. So first, she might not have a tax issue, right? And second, if you know you're gambling, it's time to move towards investing or saving.
Yeah.
That's the main advice.
Now, we know that she's a retiree, but we don't know if she's close to 59 and a half or she's older than
Right.
59 and a half. How does that change her
Yeah,
circumstance?
and I don't know if it's in a retirement plan or just inherited the stocks. If it's in a retirement plan, we might have a little bit different situation here
Okay.
from a tax
Yeah,
perspective.
good clarification.
Right? Which those taxes might have been paid upon inheritance, or it could be through what's known as a stretch IRA, which might mean that the taxes are yet to be paid until they're redeemed.
Yeah.
Or if it was just actual stocks, that's where that step up in basis can occur.
Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.